Hello students, let's continue our discussion of how banks work. You need to understand fractional reserve banking. Because banks keep only a fraction of every deposit on hand, what that means is if all the depositors show up at the bank at the same time demanding their money back, that's not going to happen. Banks simply won't have it. This is called either a run on the bank or a bank panic. A run on the bank occurs because people run to the bank and people who get there first get their money, and also because the bank runs out of cash, and this leads to a banking panic. All right, so understanding fractional reserve banking, you need to understand the role of the required reserve ratio. This is the percent of each deposit that banks are required to keep on hand. This is set by the Federal Reserve System, the nation's banking authority. They determine how much of each deposit your bank has to keep on hand. So required reserves are the required reserve percent, the required reserve ratio, multiplied by total deposits. It's going to be a dollar amount of total reserves that banks are required to keep. Excess reserves are reserves that banks voluntarily keep over the minimum. Why would they do this? They do this as an insurance policy in the event of unexpected withdrawals, and also so that they're able to make more loans when a good loan prospect shows up. Total reserves are required reserves plus excess reserves. Reserves can be held either as cash in the vault or on deposit at a Federal Reserve Bank, which is where banks keep their primary source of reserves, because the Federal Reserve distributes cash on a same-day basis to banks across the country. So banks don't have to store all of the cash themselves. So what's the role of the required reserve ratio? Clearly, if the required reserve ratio is lower, banks only have to hold a small percent of each deposit as reserves, and they can lend more of every deposit. Banks like this because that increases their lending opportunity and their income. A higher required reserve ratio means that banks are only going to be able to lend a smaller amount. Banks don't like this. Banks want to make as many loans as possible because that's where they generate income.